If your investment property hasn't appreciated much, you might be thinking that you don't need to do a 1031 exchange, but that assumption could cost you more than you realize. In this video, we're going over the tax liability that catches investors off guard, even when their property barely went up in value, and why a 1031 exchange matters more than most people think in that situation. I'm Ryan Stulman, president of US 1031 Exchange Services, and we've been helping investors and their agents navigate 1031 exchanges for over 35 years. This channel exists to make sure you understand what's actually happening with your equity before you find out at closing. The assumption most investors make goes something like this: little appreciation means a small gain. A small gain means a small tax bill, and a small tax bill means a 1031 exchange isn't worth the effort. It sounds logical. It's also wrong in a lot of cases, because in many situations, the largest tax bill at sale has nothing to do with the appreciation. It comes from the depreciation recapture, and most investors don't see it coming until it's too late to do anything about it. Here's how it works. When you own a rental property, you claim depreciation deductions every year. Those deductions reduce your taxable income, improve your cash flow, and create real tax savings while you own the property. That part feels good. What investors often don't track is what's happening to their adjusted tax basis at the same time. Every year depreciation is taken, the IRS reduces your basis in the property, and when you sell, your taxable gain is calculated against that adjusted basis, not what you originally paid. So even if the property's market value has barely moved, the gap between your sales price and your adjusted basis can be significant. That gap is taxable, and it doesn't require appreciation to exit. By the way, if you're an investor or working with one who's thinking about selling, click the link in the description to connect with our team before you make any decisions. Cost segregation makes this even more important to understand. A cost segregation study breaks a property's components into shorter life assets, which accelerates depreciation deductions and creates larger write-offs in the early years of ownership. More deductions up front, better cash flow, stronger tax efficiency while you hold the property. Those are real benefits, but they come with a trade-off. The faster you depreciated the property, the lower your adjusted base becomes, and the larger your depreciation recapture exposure is when you sell. Investors who use cost segregation are often surprised to find that a property with minimal appreciation still generates a sizable tax bill at sale. The depreciation they took on the way in becomes the recapture they owe on the way out. Bonus depreciation compounds this further. Recent tax laws allowed investors to immediately deduct large portions of qualifying assets, 100%, 80%, 60%, depending on the year. Those upfront deductions were valuable, but they accelerated basis reduction, which means larger potential recapture at the sale for anyone who's used them. This is where a 1031 exchange becomes more than just a capital gains tool. A property structured exchange can defer both capital gains tax and depreciation recapture. Instead of paying federal capital gains tax, state taxes where applicable, net investment income tax where applicable, and depreciation recapture, an investor can roll that entire tax liability forward into a replacement property. The equity that would have gone to taxes stays invested. That's the equity available for repositioning, diversification, consolidation, or trading up into a stronger asset. The investors who benefit most from understanding this aren't always the ones sitting on massive gains. They're often the ones who held a property for years, took their depreciation, used cost segregation or bonus depreciation, and assumed the exit would be straightforward because the value didn't move much. The tax bill doesn't always come from where you expect it. A 1031 exchange gives you a way to move forward without losing the equity you've built, even when that equity is harder to see on a balance sheet. And that wraps this one up. Again, if you need more information about a 1031 exchange, follow the link in the description below.